Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show. We are back once again this week, trying to have some, information that's useful to you if you want to buy a house, you need a mortgage, all those kind of things. Now, this isn't a commercial show. This is an informational show. We're going to bring 3 guests on, as we do each and every week, at least 3, to talk about what they know, whether it's a lender, or whether it's a loan officer or a real estate agent, to come on and describe their business, what kind of products they offer. We've had a lot of different calls from people who are listening to the show to these people, asking them about the programs they described on the show. So that's part and parcel of what we're doing today, but it's difficult right now because there's so much confusion in the marketplace about what really is going on. And isn't that always the way it is? Trying to figure out what's going on, what is the best thing for me, how can I best use this information to be able to either get me the best rate or the best loan officer or go to the best lender, or even just to get information for a friend, a family member, somebody who needs help, because this is a daunting task if you've never done it before. Now, I have 3 kids, and I have visited all of them once I got my shots. Yes, I got shots. I went out to Seattle, Portland, and to Boston, Massachusetts, to see all my 3 kids over the last 3.5 weeks. And I got to tell you, in all of these different places, the way they tackle the problem of the mask is kind of like how we tackle the problem of mortgages and figuring out the best product, or trying to figure out the entire way it works, and then to be able to trust somebody. So the masks up in Portland, everybody's doing it when they're not burning down the city. Now, that's, of course, a joke. It's not as bad as they say. And up in Seattle, it's raining all the time, so everybody's inside, so nobody's wearing the mask except when they have to. Here in Southern California, of course, where I live, mask mandates are gone. And out in Boston, it's also gone. But most people in public areas are using the mask. Now, if you look for a 30-year fixed-rate loan, and you want to get the best possible rate out there, because everyone wants to get the best possible rate, it depends on who you are and what you are. What kind of you is the loan going to be qualifying for? And in the midst of all this, the changes based on what's going on in the mortgage market itself and how different things affect rate in general. So you're dealing with, like the masks, all these different variables, different kinds of people. I'm going to do it this way, you're going to do it that way. Regardless, the Fed sets a lot of what we do, right? In terms of momentum in the economy, for how money is used and borrowed by large institutional banks. The rate itself is not set by the Fed. It's set usually by the 10-year Treasury yields, or the bonds, as they call them, whatever that bond yield is. Yield is up. That also means that the rate that you want to get is also up. So these things being what they are, it is confusing because it doesn't make sense. But I can tell you that for the past 3.5, 4 years, the rates have been extremely low and will probably remain that way through 2022. Now, how much and what is low? Some people are crying because the 2% or 2.5% loans are gone, right? They're gone from the marketplace. Well, they're gone from the marketplace today, and that's true. Let's talk about rates just in general before we move on. 3.2% for a 30-year fixed. These are averages across the country. 2.62 for the 15-year. The FHA loan is at 2.75. Jumbo is at 3.18. Now, that jumbo number is frozen. It has been that way for 6 months easy, maybe longer. And the jumbo loan product is not a Fannie Freddie loan, and it's usually sold to different types of investors. So therefore, that particular rate doesn't move all that much. And the 5/1 ARM is at 2.28. I had a friend call me the other day, say, what is the ARM product and how does it work? Interesting, right? If you're looking for something in the twos, and I just quoted 2.28 for a 5/1 ARM, well, 2.75 for FHA, but there too you have to have a mortgage insurance premium on top of that, and that's going to push that up at about 3.5%. So if you're looking at a 5/1 ARM and you know you're going to be moving from that property, or you know you're going to get in and out of it quick within 5 years, you want the 2-year exemption because you want to claim that you live there, and then you want to sell it and maximize out what you can. That 2.28 5/1 ARM, that's 5-year fixed and adjustable after that. That's a good product if you know what you're doing and if you stick to the game plan. Now, I can't predict in the future, of course, how house prices are going to go or where the mortgage market will end up. But in general, over the past 5 years, the rate for the adjustable has been really close to what it is for the 30-year fixed anyway. It doesn't really move. So if you've got a 2.28 today on a 5/1 ARM, it's probably going to be close to that in a year or so. You have to watch it because there's also an amount that it can go up every year and a cap over the life of the loan. Usually you have to get approved, and this is the kicker to this loan, not to the rate you're going to pay, but to the cap of the greatest amount of that particular loan. Like, let's say you've got a 5-point cap on this thing. So the loan could ostensibly go to 7.28% within 10 years. They qualify you for that. Can you pay that? It doesn't mean you're going to pay that, but you have to qualify for that in order to get that particular loan. That's the downside of it. The upside is if you can qualify for that, this is a smoking loan if you're going to get out in less than 5 years. For everybody else in the marketplace who is looking around to see what the heck is going on with rates and how they're going to be able to secure that loan with the best person out there, yeah, I understand. It is not simple. Real estate prices have gone up and down. Now, what we've seen in real estate, which also affects some of the market, it affects the availability of properties. Thus, the availability of properties is going up. We had less than 3 months availability of properties across the country. Some sections a little bit more, some sections a little bit less. If you're down in Albuquerque, you know what I'm talking about. Certainly in Southern California, in the IE, up in Tahoe, absolutely. And in Vegas, it's on fire out there. So all of those particular 5 markets that we just described, we know real estate prices there and where they are. But in most places, other than those particular places, especially here west of Denver, let's say, you're going to see that inventories have risen, which means that prices should stabilize, although it takes a seller 6 months to realize that there's more houses out there and they ought to lower the price in order to sell it. But it's currently, let's see, we've got about 5.1 months nationally of inventory. Now, we had 3 months or less last month, so inventory is up. Usually means prices comes down. As I say, the caveat is usually takes sellers 6 months. The mortgage market itself has been really relatively flat over the past month. It is where it is and probably where it will stay. Now, the several things that we got to think about which will affect rate beyond what the 10-year does. The 10-year is currently at about 1.5. That means the yield you pay when you buy the bond is 1.5% of the amount of the bond, and you get that on a yearly. So however that is divided up by 12 months, that's what you get. If, in fact, we're talking about rates for other products, let's say you want to get into a 15-year, you want to get into a FHA, you want to get into a jumbo. These rates are also not affected too much by the bond market since all of these are basically fixed. When you talk FHA is usually rates for people with bad credit, people who have low income. And so those particular rates are fixed at a point because they also have to pay mortgage insurance premiums. But the bond market itself and how it affects your rates is also affected by inflation. Now, you've heard a lot of talk about that. Of course, every time there's a Democratic administration, you hear about inflation and crime and what else do you hear about? You know, the whatever drive, and the debt, right. These are the 3 things that occupy the news, but they also affect mortgage interest rates. And I'll get into that in an additional segment later on in the show, just to show you how beyond the bond, there are things that affect the rate. Those things that you can watch, those things that affect you directly, there are two different ways to approach it, and I'll talk about that a little bit later. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Thanks very much for listening each and every week. We try to bring to you information that you can use. Sometimes I get to lecturing, and I apologize for that, but there is so much going on all the time in both the government as well as lending and different programs from different lenders that it almost seems like it's too much. So I try to get as much information to you as possible in the shortest period of time, and sometimes it just sounds like a lot of noise. So again, I apologize. But to help me sort out a lot of this stuff are the experts in the field. I'm just one person who runs a little company, but there are many large, good companies out there who have a great handle on products as well as what's going on in the marketplace. Noah Sheffman joins me today from New Res as one of those guys. Hey, Noah, how are you?
Good, Jeff. I'm great. How are you?
I'm fine, thank you.
Me.
Thanks for coming on once again, and I do appreciate it. New Res, tell us about what some of the newer products you might be getting into now, and I'm not sure if you're tackling QM versus non-QM. Just tell me about what's going on there and how you're helping the borrowers.
Yeah, absolutely. So we for sure are getting into products that we weren't, well, I shouldn't say weren't in previously. We were, and then, of course, there was a pause in the market with jumbo lending and non-QM lending when COVID hit, but things are starting to, it seems, come back somewhat to quote-unquote normal, which is good. So over the last couple of months, we've re-rolled out or reintroduced several of our jumbo program options, which, are loans above the agency conforming or high balance limits, and also non-QM. So we absolutely are in the non-QM market. As a matter of fact, before COVID hit, we were one of only two lenders that were doing multiple securitizations per quarter out there. So our non-QM product is our own product. We are the investor on it. It is our own product, which is a huge advantage because we can be agile and shift as needed because we're not dealing with a different investor. And the fact that we are securitizing so much, multiple securitizations per quarter, tells you we were doing a large clip of it before COVID, and we are extremely excited to be back in that sector. It is an underserved, however, the hot button word, I guess, in the industry right now is non-QM, much like it was a year and a half ago or so.
Right.
We have three products currently on non-QM. We actually kind of consolidated our product mix from before COVID just to make it easier. So we kind of whittled 6 programs down to 3, but we have most of the same offerings just in those 3 products as opposed to having separate products for each kind of niche. So of those 3, I have what we call our smart. My non-QM products are called our smart product line.
Okay.
And we have the Smart Edge program, which is a full doc program, and it's on edge because it's on the edge of agency and government. So it's for those borrowers who are fantastic, qualified borrowers, full doc. They just don't quite meet the A-paper jumbo guideline requirements, which tend to be a bit more strict than your, conventional agency loans. So we allow on that product higher debt-to-income ratios, higher LTVs, interest-only, non-warrantable condo offerings, lower reserve requirements, etc. So there's a lot of nice niche offerings on that full doc program.
Right.
We also offer the Smart Self, which is our bank statement program for self-employed borrowers, hence Smart Self. A lot of the same offerings on that product. It's just you're doing your income calculations based off of a cash flow over the last 12 or 24 months of business or personal bank statements for self-employed borrowers. And then lastly, our Smart Vest product, which is for investors, and that's a debt servicing product where you qualify the borrower based off of the cash flow of the subject property versus off of their income. And that's for experienced investors who've had investment properties, at least 12 months history of owning investment properties.
Now, the non-QM market and jumbo, two things. One, non-QM, the fact that you, and I don't know if it's caught by the listeners, but when you say securitized, what do you mean? Just explain that a little bit so you can show the people listening how that's an advantage for them.
Well, that's an advantage because what that means is oftentimes if you're dealing with a lender, there are what's called investors out there, right? So the investors are the ones basically buying up the paper. They're the ones with the money, right?
Right.
And so you have lots of lenders out there that are selling investors' products.
Right.
So they have to adhere to whomever's buying that paper. They adhere to whatever guidelines that investor puts forth, right? So they do a bunch of the loans, they package it up, and they sell it in bulk to the investor, right?
Right.
When we're securitizing on the secondary market, that means we are the investor, so we are adhering to our own guidelines that we write. Now, there are some other guidelines that we don't have to get into, but Appendix Q and regulated guidelines that you do have to follow, obviously. But we can be a little bit more flexible with what we feel comfortable with because we're the ones financing the programs. Now, securitizing, it means you go out on the open market and you sell it in bulk to investors that are interested in holding that paper. But you are not held to one investor's guidelines. So we set the guidelines and then take it to market and sell it to investors on the open market. So it is an advantage using a lender that is securitizing the business and actually is the investor, because you're going to avoid things like secondary signature sign-offs by the investor, which can cause you a lot of time when you're trying to close a loan. It can also cause you a lot of heartache because you think you have a loan that's clear to close, but then they have to send it to the investor for second review, and the investor comes back and says, no, we need these 10 more items, etc.
Right.
So you avoid all that when you are not only the lender but the investor.
Excellent. No, that's a good explanation, and I absolutely agree with you, which is why I brought it up. The jumbo rates. Now, the jumbo rates are really steady and have been for 6 months. Is that because they're not being sold to Fannie Freddie because they're jumbo and that the secondary market loves these jumbo loans, and so therefore it's a very steady rate at around anywhere from 3 to 3.25%?
I mean, I'd say bingo. Yeah, it's not. They're not subsidized by the government, right? So you have private investors or banks, which obviously I say private investors, but they are often public companies, right? And depository banks that buy this paper. But yeah, you're adhering to investor guidelines versus agency or government guidelines. So maybe not directly tied to the bond market, et cetera, though they are.
Right.
But it's all dependent upon basically the secondary market for those loans. And, that secondary market for the jumbo product disappeared for a year and a half.
Yes,
right?
it did.
COVID, it fell off the ledge very quickly. But now it's coming back. The market is stabilizing. And, investors are seeing the need and seeing the value in that paper. So I think that's why you're seeing, historically low jumbo rates.
I agree.
Right now. It's amazing.
It is really amazing. That's why I wanted to hit upon it, because these jumbo rates are really spectacular. In your jumbo programs, what are your parameters and what are you looking for in a jumbo borrower?
Yeah, it's harder to answer that in kind of an all-encompassing
I get
answer,
it.
because with the jumbo product, it is investor specific. So while we are the investor on our non-QM business, for the most part on jumbo, we are not. So there are investors that we're selling to.
Right.
Now, we're fully delegated, which means that we're not sending it out to anybody for second signature. We've passed all their tests, and they trust us to underwrite the files accordingly. But you do have to adhere to their guidelines, and every investor has different guidelines.
Right.
My different products have different requirements. But generally, when you're talking about a paper jumbo, you're talking about very well qualified borrowers with low debt-to-income ratios, meaning their debts against their total income is relatively low, and that's generally across the board. It's 43% or less, which is lower than agency or government loans, right? And, loan amounts, though LTVs are different, meaning your loan to value, et cetera, is different and generally lower. So it's a more conservatively underwritten loan because you're lending more money. It makes sense.
Right, of course.
So you don't want to lend a lot of money at a very high risk loan. The higher the loan amount, the less risk an investor is going to take. So we have historic rates. You do see some products out there that are starting to get more aggressive. I mean, when you're in a market like we're in, obviously it's a seller's market. There's a lack of inventory out there as far as the housing market is concerned. But it's also a very competitive lending market. So you see these low rates because investors and lenders are competing for the business right now. A year ago, business was crazy and everybody was trying to keep up with what was coming across their desk. And that has come down a little bit, right?
Yep. Hey, no, I'm up against the clock here. I'm sorry. I could talk to you for an hour because the information is just so gold. We're just up against the clock, and I really appreciate you coming on. We've been talking to Noah Shuffman. He's with New Res, and that particular lender is, as you can hear, not only really got a lot of great products, but you're dealing with a terrific account executive. Have your broker please give him a call. That's New Res, and it's Noah Shuffman. Noah, thanks very much. I appreciate you coming on.
Hey, Jeff, always a pleasure, and I appreciate it as well.
Excellent. Thank you very much. I'm Jeff Barton, your voice in the music industry. Listen to that, in the mortgage business, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening each and every week. We bring to you information, people, and hopefully some solutions to whatever problem or questions you might have about not only mortgages, but real estate, the business itself, where it's heading, how and why it does what it does. It's not as simple and straightforward as you might think, and whether it's overly politicized in some respects, most of it operates behind closed doors and you don't really know anything about it. So you're at the mercy of loan officers. I brought today with us a terrific loan officer, has received some great endorsements by clients. Bill Orr from Malibu Funding joins us. Bill, how are you, first off?
I'm great, Jeff. How are you today?
I'm good, thank you. And the market just seems to be, and keeps to be roaring along here. How is it for you?
Yes. Yeah. I'm seeing the same thing too. I mean, the purchase side, it's just cray-cray. I mean, just multiple offers and multiple offers and multiple offers, and both real estate agents and potential home buyers are frustrated that they can't get their offers accepted. So it's I've said it a lot of times that sometimes real estate can be a contact sport. I think we're seeing that sometime in Southern California anyways, yeah.
Yeah, I agree with you. Okay, so when you are talking to realtors, and obviously that's the lifeblood of the lending industry in normal times, right? We need to have real estate agents who trust what we can do and deliver. How do you promise to them you can deliver if you've got issues like, okay, timing, lenders are busy, so can they turn? Appraisals. Everyone's busy, so they might not, happen as quickly as possible, or in the case of some Arizona loans, not happen at all. How do you satisfy the needs of the realtor and the client and still be able to deliver for them?
Wow, that's a great question because that's a real mouthful. I mean, everything you hit on is exactly right. I mean, appraisals can be a problem, so I'll tell you a couple horror stories.
Yep.
Just within the last 45 days, I had one up in Eureka, California. Nobody would come, no appraisal would answer the call, like they just wouldn't do it. So we finally reached out to a couple of guys. Long story short, the appraiser said the normal price for an appraisal is about $550, give or take. This guy said, for $2,000, I'll have it for you next week.
Oh, my. $2,000.
And the buyer was in kind of a pickle, and they had to close, so he paid it.
Wow.
I had another one, like literally 10 days later, 2 weeks later. It wasn't 2,000, but it was over 1,000. And same thing, the buyer was in a pinch. He had to do it, so he had to pay a premium. And I had another one where the appraisal order was $545. I think we requested we requested a rush order, and the rush fee was the exact same price as the appraisal fee, $550.
Yeah. Wow. That's amazing.
You're right. You raise a very good question. Now, in some situations, if the client has good credit and if they're placing a large down payment, sometimes we can get something called an appraisal waiver.
Right.
Which means we do not have to do a property appraisal, but you can't count on that.
Right.
That's on a onesie-twosie basis, and if it happens, then good for you. But it's a real challenge. And then the other thing is, how can we get it done? I had one recently this week. As a matter of fact, the closed a couple of days late, and it's a real struggle to get these things done on time.
Right.
And you just have to, for my job, I have to really stay on top of all the deadlines, make sure that I get everything done quickly, and even still you run into trouble because there's just more problems. Every person is unique and different.
Yep.
And on the surface, I had a guy who's a registered nurse and an MBA, so he's making very good money. But the problem I had with this guy is he was putting $10,000 into Schwab, and the next week he put $15,000 into Citibank, and another $2,000 to Chase, and it came down to close. We had to track and trace all this money down for this guy.
Right.
Because any time for people who are listening, when you buy a house, mortgage underwriters are extremely detailed.
Yep, they want to know where the money came from. Yep.
That goes into the transaction. Like you cannot use cash, for example. Any money that you're going to bring in for down payment and closing costs, we have to track it. Where if it was transferred from another account, then we have to get 2 months of the other account and so forth. So it can be tricky. It's not as easy as point and click like you might hear on the radio. It's not.
No, I think what you're describing is also a lender's ability to look at a file as a person as opposed to just automatic underwriting and whatever it says, that's it, and you just cookie cutter these things. We try to tailor, and I'm sure you're like this too, to make each client not only feel, but to get the kind of service and also the speed to get it done quickly, the service that they would get that they can't get from a cookie cutter loan outfit. And obviously, all of that takes time. And as you said, it's not an easy.
And online work, it's mandatory, and you cannot just fax it in. You literally have to take each one because there's always going to be a little nuance. And what I run across all the time still are inexperienced loan officers who get to the client first,
right?
And then I have to kind of come in after the fact and explain to them, what the reality is. Because if you get somebody, not to pick on the big banks, but I used to work at Wells Fargo, so I'll pick on them, or Bank of America, whatever. They get these people who just got licensed, and maybe they worked in the bank as a teller for a year, and they got their mortgage license, so they're now doing loans. They've only been doing it for 6 months. Well, there's so much that these people just don't know.
Right.
Even if it is somebody working for me, a brand new loan officer, they're not going to know what I do, and they're going to make mistakes, and they do make mistakes. And then it's up for senior loan officers to try to guide the client along to make sure that they're given the proper information, and we can get the transaction done for them. And misinformation is out there. Sometimes a loan officer won't be 100% honest with the client and telling them what they think the client wants to hear, and that's a big disservice.
Of course.
And I learned early on in my career that you have to have the backbone to tell the client the truth, even if it's bad news or even if it's not good news. You have financial responsibility to tell the client exactly where they stand.
Well, I think that's true. And I think what the problem of it is that during the loan process, the facts change, i.e. the program changes, the rates change. And, if you are looking at someone who says, well, you said this and you said that, it's not like that. For instance, if you're floating, meaning you're waiting for the rates to go down in order to have the client qualify because they won't qualify at this rate, and you tell them that, and then the rates do go down, and for whatever reason they can't lock that rate, they're not around, you can't get them to do it, and the rates go back up, they blame you, the loan officer, when really this is a function of the market. This isn't about, a fault or anything like that. And these things happen all the time within, as you said it, trying to source income, trying to source bank statements, all of this stuff. It is not simple, and it changes. And the guidelines that require you to do that also are in flux.
That's right. And so what this means to the person who is listening to the show is you want to lender or home sellers will no longer accept their pre-qualification. It has to be a full-blown pre-approval.
Right.
We have a loan officer sit there, and you go through your paycheck stubs, you go through your W-2s, you go through your tax returns, and you go through the bank statements, and go through everything in detail to make sure there's something that's not out there that's going to cause a problem. You get a full computerized loan pre-approval from either Fannie Mae or Freddie Mac or FHA, and you run credit. And it's up to I have personally spoken to clients who met face-to-face with, in this case, I'll name names, Bank of America loan officer, and the loan officer told them they were qualified simply by looking at the arithmetic of comparing the client's income versus their expenses, paying zero attention to the fact that they didn't have the money to close. They didn't have the money to close. These people thought they were approved for $550,000, and according to the arithmetic, they were, but they didn't have the down payment and the closing costs.
Right.
They're not qualified.
Right. They are not qualified. Bill, we're up against the clock. I really appreciate you talking to us about this really important process of finding the right person so that you can get the approval that's not only useful, but that you can close on. Bill, thanks for coming on the show. I really appreciate it. You want to shout out your phone number?
Yes, my name is Bill, and my last name is Orr. ORR. Phone number 818-406-4744. Again, 818-406-4744. And don't let the 818 area code fool you. I help people in Eureka. I help people in San Diego. I help people in Palm Springs. If it's in the state of California, I can help.
Thank you, Bill, very much for coming on the show. Really appreciate it.
Thanks so much, Jeff. I appreciate your time.
Sure, and that's Bill Orr from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening to the show. We are down in Albuquerque, and we are in Las Vegas, Nevada. We're up in Tahoe, Lake Tahoe area at K Tahoe, and of course in Southern California, flagship station down there, KCAA, KMET. Great people, great place to live. Building houses, more of it, less of a problem because we have inventory that has increased up to 5.1 months. And what does that mean for builders? It's interesting. I was reading an article about building new homes. Everybody wants a new home, don't you? I do. If I'm going to move somewhere, I'd love to get into a new home just because you don't deal with the hassles, the problems, and especially with COVID and the way people's minds wig out, you're not thinking about, whether there's a problem with that or some other disease or some other. Anyway, builders look at the way inventory grows or shrinks as an incentive by which they're either going to build more or build less. Obviously, they're in a business that you have to plan years in advance, maybe even decades in advance. Well, after 2008, when we had the real estate, mortgage, and economic crisis, the meltdown here in the States, what a lot of these builders did is they went to a different type of format and program. What they looked at was, okay, if we're going to build houses, we have to see that the actual people, the people who are going to buy out there, don't have enough inventory. Now, what we've seen in the U.S. since COVID is rising prices, less and less inventory month after month. So builders got on their hobby horse and decided to build. So we've seen a lot of activity in the housing market, whether it's up in Salt Lake or whether it's in Las Vegas, whether it's up in Reno, whether it's in the Inland Empire up to 15, whether it's down in Albuquerque. In a lot of these markets, what we saw and have seen is building, but not to the tune of what we had in 2004, 5, and 6. In those days, they were rolling. I mean, I went to two areas, right? I went down into Phoenix, Scottsdale area, and I also went out into Las Vegas. Now, I've had a license in those two states for well over a decade, maybe longer. And I have watched the way that rolled out in those days. And they would roll, I don't know, they would do a section of 25 to 50 homes a month. And in several different areas in Las Vegas, same thing down in Phoenix. Now, if you're running with Pulte, or you've got ASICS, or you've got Huarde, or you've got, there's so many home builders, and they're all doing the same thing, you're putting onto the market thousands of houses a month. And the demand was such that you were keeping up with it. But what happened, especially, and look at Florida, they were plowing these under after 2009. They overbuilt, and they got stuck with a lot of this on their books and in their inventory. So they decided not to do that. So what they went with was deposit, build, deposit, build. They would build when they got buyers, as opposed to build it and they will come, right? Well, that's not how they're doing it today. So what we've got now is a very interesting situation where we have right now in late June 2021, we have inventory that has risen from, the low 3 months of inventory, maybe even lower. Now it's up to 5.1 months of inventory nationally. So the builders have gone back to give me the deposit, then I'll build your house, as opposed to walk in and buy, close next week. That has slowed the building process. Now, we all know that housing in America is still one of the biggest problems because we cannot house the people we have because there aren't enough affordable houses. Affordability has to do with availability, supply and demand, right? If there are not enough houses, you're going to pay more for the houses that exist. If there are a lot of houses or too many houses, then it becomes a buyer's market. Now, this is what new home builders have to deal with. So we've had shrinking permits in the home building area for the last couple of months. Why? Because they foresaw the trend. And when people were going back to their previous lives, they're traveling a lot, they're spending money, they're not necessarily focused on moving and buying new home. That simply means that the inventory rose, and that's where we are right now. So the profit incentive on housing is such, and we can debate whether that's a good thing or a bad thing, but it is such that the big home builders are not building the way they used to. Eli Broad, Aspen, there's all kinds of home builders out there. Now, the infill people, the small unit, the ones that build 3 to 5 houses, they're still around and they're looking for infill deals, but usually in neighborhoods that can support a price because building is so expensive. Lumber prices, yes, have come down, so that makes it a little bit cheaper. But trying to find a sub, trying to find a painter. We had a painter come to our house. We had to book him 6 months ago. Why? Because they were so busy during COVID. Surprising, right? No, a lot of people stayed home. They did home fix-up. They, had their house painted. They did new plumbing. They added an additional room because they needed the additional room not only for childcare at home, but obviously for the home-based business that they now have to run from their garage. They wanted to add a room in order to do that. So all of the subs out there have made also building, or for the infill people, much more expensive, as lumber did, as we saw it go up 700% last year. That is ridiculous. It has since come down. Why did it go up? Sawmills were closed. Why did a lot of food go up? Because processing and a lot of people who worked in those jobs also are not working. There are a lot of things to discuss about what's happening in the building process, but that's one reason why new homes aren't keeping up with demand, because they do something called deposit build, as opposed to build it and they will come. Okay, a couple more things before we close up the hour. Let's see. Oregon passed law forbidding buyers' letters. Okay, so if you're a buyer out there and you're looking to purchase a house, a lot of times, and I do this too, you have your buyer write a letter. Hi, I'm this kind of person, and I really love this, and, we're planning on doing this with the property, and me and my partner, or me and my wife or husband, or me alone, we're out here, and we're going to make this neighborhood great, and I love what you've done, and we're going to, these type of letters, they're called love letters. Now, do they help? Yes, I think a lot of times they do help. They humanize the buyer as a person, as opposed to the largest number gets the home, i.e. the biggest. And a lot of times when you write a letter like that, it shows that you are someone who cares about their property. And a lot of sellers have emotional attachment to their property and want somebody to take care of it. So that's why a love letter like that. Well, in Oregon, they have not allowed it. It is now illegal to write that kind of letter. Why? Because they said that these types of letters may influence and prejudice the seller to sell the property based on things other than the quality of the buyer, the quality of the offer. Now, what do they mean by that? Some buyers would send pictures. Okay, so you get into the area of discrimination in housing. And again, is it discriminatory? Here's another question. Is it discriminatory for me not to want to sell to you just because I don't like you? Is that discriminatory? And can that be used as an argument in any kind of legal basis by which to buy or sell properties? I.e., Oregon said, yes, it is the basis. So we're going to nip it in the bud and not allow a certain thing that might give credence to the fact of who you are beyond just your financial offer. I think it's a mistake. I think it dehumanizes the process. And I think a lot of people who sell their property really want to sell it to somebody who cares. People who write love letters or caring letters are those types of people, and I think it's a mistake. A lot of people agree with me, but Oregon just passed that law. It may be coming to a town near you soon. Cutting benefits, lower unemployment rates, claims, but it does increase in hiring. Okay, so some states have cut the unemployment benefits, that $300 federal subsidy that they've also given as a weekly to unemployed people. Now, getting people back to work is one way by which the economy can recover, and one way by which we think full employment will help cut inflation, i.e. more people, more buyers, less need to raise prices. The question is, by cutting, do you actually cut the number of people on the unemployment lines? I.e., if you do that, does that also mean, conversely or adversely, that you're adding to the employment numbers? We're not sure. The data's not in, and that's yet to be understood. Inflation, debt, those are the drivers of the news cycle. What is the impact on you as a borrower? It may affect you with inflation. It may affect you with how particular neighborhoods are perceived. And all of these things are things that affect the mortgage rate and the mortgage market as well as real estate. Anyway, it's been a great show. Thanks very much for listening. I'm Jeff Barton, your voice in the mortgage industry, and we will be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show, and thanks very much. Each and every week, we put the show on for you. Get a lot of great feedback, especially from the guests that we bring on. Everybody wants to talk about programs and the different ways by which a particular borrower has needs for a particular type of loan, and there's a lot of products out there. So the feedback we get and the people who do call to ask for that information, thank you. Keep calling, keep emailing. All those things really help. We want to thank the listeners down in Albuquerque, New Mexico. Next week we'll have a couple of people, if not one person, come on to the show, talk a little bit about your market, what's going on. Same up in Tahoe. It's a local market we give love to, but not enough, so we're going to try to do a little bit more of that. In Vegas, absolutely, as well as in Southern California. All of these terrific markets. We're also on 10 different podcasts. Daryl, you have the list of those podcasts in front of you?
I sure do, Jeff. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
That Podclips.io is a new Podclips center where you can go there. There's a lot of different people talking about information that you're going to need on all kinds of subjects, lifestyle, health, sports. Our particular area is finance, and I'm on there with several others to talk about different types of the way that you use finance and how it affects you and your life and what you're going to do in order to be able to be an expert in that area, at least know more than you do now. A lot of these podcasts, as well as what we do on the radio, are designed to really bring you up to speed. I'm not selling anything. I do wish you would come to my company, which is Malibu Funding, Inc. They sponsor the show, and I appreciate what they do each and every week. just to give us a shot. But if not, go to any of these lenders, any of these guests that come on the show. They're all there for you because the information that we provide is a service that the company does, and I happen to be wholeheartedly behind that. Getting people into housing, that's what we're trying to do, whether it's somebody with a ton of dough or somebody who has a lousy credit score and a minimum wage job. How are we going to get you into some kind of housing? A couple of bits of news on the housing front, by the way. Supreme Court came down with a decision last week which talked about the president's ability to be able to hire and fire at will. Now, a lot of these commissioners that were installed during 2008, the SAFE Act and Dodd-Frank bill, we knew quite a bit about this. There was a lot of hubbub and debate during the Trump presidency about the I don't know whether it was good or bad, and there's a lot of screaming and yelling. Well, this quietly went through. The Supreme Court said, yeah, the president absolutely has the ability to hire and fire at will, and they called it separation of powers. Therefore, Mark Calabria, who is the commissioner or the director at FHFA, and that is the oversight regulatory agency for all lenders and all financial aspects of lending as opposed to the CFPB. Well, both of those positions can be hired and fired at will, and the president has accepted Mark Calabria's resignation as soon as that decision came down. Mark Calabria resigned, and in his place, there is a new FHFA commissioner, and her name is Sandra L. Thompson as the acting director of FHFA. She comes with huge resume of working for the FDIC and working over at the Fed and working with a number of different agencies in the federal government. Part of what during the last administration and this particular administration, there is a very large bureaucracy that works tirelessly for you people out there. Now, whether they have a political bent or a particular way that they view things, yes, I understand, and that is certainly something to consider when you're thinking about supporting them or not supporting them. But with the expertise that this person brings to the job, you can rest assured that whatever is in a regulatory fashion that helps consumers will be considered first and foremost. Now, will that help business? I'm not quite sure, but I think that we're in good hands with that person at the wheel. I haven't done enough research on it, just a few comments. I am honored that the President Biden has designated me to be acting director of the FHFA, she said. I look forward to serving in this role at a crucial time. Now, one thing about all these people in bureaucracies is they all say the same thing, and that's one of the reasons why we all hate them, right? But to do the job of regulating banks, mortgage brokers, and the like, in order to make sure that both Fannie Mae, Freddie Mac, and Ginnie Mae are on the up and up. Now, I think during the last administration, Mark Calabria wanted to jettison or have Fannie Mae and Freddie Mac go from conservatorship into private ownership. I happen to think that this particular director will not do that and will keep close both Fannie Mae and Freddie Mac. There was a sweep being done, which was ended during the last administration. There were a lot of things done during the last administration, some things that didn't get done in terms of releasing Freddie Mac and Fannie Mae from conservatorship. One of the things that they did get through and did get away with was Treasury used to sweep, what they call sweep. It really is taking the money that Freddie Mac and Fannie Mae earned and putting it into the Treasury, and they would do that once a quarter, and it was quite a bit of money. It was $4 billion for Freddie Mac, and I think I want to say $8 billion for Fannie Mae. It could be reversed, but it was a significant amount of money each and every quarter. One of the things that FHA, Fannie Mae, and Freddie Mac needed to do in order to exit from conservatorship is to build up a significant amount of cash to cover the short side if we had another situation like we had in 2008 or something close to it. But it would be hard to build up a reserve of cash if the Treasury was sweeping your money each and every month. So one of the things that Calabria did, and I thought it was a good idea, I still think it's a good idea, is to stop that so that both Fannie Mae and Freddie Mac can build up those reserves so that one day they can actually get released from conservatorship. And one of the downsides, in another Supreme Court decision, it said that the releasing from conservatorship is not mandated, and that the government, the Treasury Department, I guess, can decide if they're going to release them or not. and that went all the way to the Supreme Court, another decision that came down within the last couple of weeks. It really upset the bondholders and the stockholders because both of those companies are privately held, or at least were privately held, until the bailout in 2008. So what happens to those, and what happened to the stock market is we took a big nosedive on Tuesday as a result of that decision. We have since recovered some of that amount, but as all of these decisions go, most of it is lost on the American public, and for you to look at this and say, yeah, well, so what? Who cares? How is it going to affect me and my ability to get a loan? Well, one of the things that we always debate in the business is whether government should be in the lending business at all. And I know that there is a great push to remove government's responsibility from lending. Well, since the advent of Freddie and Fannie and the crash of 2008, it has become even more apparent that that particular route that Calabria was trying to go, and that I think the Trump administration was trying to push, is not going to happen during this administration. So you are now in cahoots or bed or whatever you want to say with the federal government when it comes to the collaboration or the partnership, Fannie Mae, Freddie Mac, even Ginnie Mae for most of FHA, even though FHA is a government program and that's never going away. They're going to be joined at the hip, and that particular aspect of lending isn't going to go away. So affecting rates, you're going to get guaranteed, they're going to guarantee the loans to the servicers and the lenders. That's what Fannie and Freddie does, especially if you follow the QM rules. Now, there is all kinds of reasons why you should know what QM is. Those are the 30-year fixed-rate mortgages, usually 20% down, kind of, with, a FICO score above 620. And those loans all get sold to Fannie and Freddie. Now, Fannie and Freddie have $1 trillion on their particular portfolios. They get bundled into mortgage-backed securities and sold on the open market in order to continue to keep funds rolling through Freddie and Fannie to lend out to you. There's new procedures coming, new policies coming for what qualifies a loan as a qualified mortgage. Now, they're not going to come into existence until, or mandatory existence until, I think, June of 22, so about a year from now. However, July of this year, some lenders are going automatically to the new proposed QM regulations. We're up against the clock, so I can't get into it, but I want to get into it. There's so much going on and so much explanation about all of this and how it affects you. Things to watch, things to keep your eye on, because the market is changing. There's a glut of houses, not a glut, but there's more of a glut of houses now, and the rates seem to be pretty good. So if you're out there looking for programs, they're still out there. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show this week, and we will see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.